Hi, I'm Rushil Vallabh, MD and co-founder at Secha Capital.
Hi, I'm Brendan Mullen, MD and co-founder of Secha Capital.
Welcome to the African Tech Roundup, Rushil, or should I say welcome back to you, Rushil, and welcome to you, Brenden.
Thank you very much. Glad to be here.
It's good to be back and always happy to chat to you.
You were the first sort of non-overtly tech investor type finance professional that we had on the show. And so the response was quite interesting. What we didn't have an opportunity to talk about on the previous podcast is what would have inspired you to leave consulting? What sort of ideas you set out to act on? Who wants to go first?
Sure. Maybe I'll take it since Rushil has already, his languid voice has already been on your airwaves. So I think, there's two components of it. It's one personal, and the second is kind of optimizing for impact and for returns, right? So on a personal level, Rushil and I were at Bain, and we had a great experience there. Learned a lot of skills, met a lot of great people, but increasingly we wanted to do the work after the slides. We learned a lot about various industries, and we saw the capability that Bain could bring, but then execution is a big component of it. So that's why Secha Capital is, and I'll kind of give you the quick shorthand, is an operationally focused small private equity fund. We invest patient capital in return for equity in established South African SMEs in the FMCG and agri-business space. We actually join the management team by working day to day with them, and often bringing in an intern from a Bain, from a McKinsey, from an MBA to serve as the chief of staff. And then we grow the SME to full potential. We often say they've gone 0 to 1. We take them 1 to 10. Now, backing up a bit, why this model for Secha Capital? And if you look at, as Rushil and I have said, maybe a little bit arrogantly, we want a new model for private equity in Africa. And first, you start looking at private equity. Now, who are the best private equity players out there? Because as many of your audience likely know, private equity actually you outperform consistently. Unlike an asset management firm, I used to work at a hedge fund. The best hedge funds over a 5-year period, they don't necessarily repeat over the next 5 years. But that does happen in private equity. Now, why is that? Well, it's fundamentally 3 things. It's deal flow, it's capabilities, and then underlying that, it's size of the fund. Often if they grow out of it, they're no longer outperforming. So we wanted to make sure that we had a fund that could maximize the skill sets that we could bring and could enable us to write the right size checks to the biggest funnel of deal flow. And that's why we've tweaked the private equity model to be more like an accelerated search fund. And we've tweaked it slightly across the find, fund, support value chain. Right? So in terms of find, we like boring businesses, essentially, in those sectors I mentioned, but they're established. They have positive gross margins, and they have annual revenue of maybe 5 to 50 million rand. These are not big, tech plays. These are often family-run organizations that have already done a good job. They have a few clear capabilities, product market fit, and they just need a little bit of extra help to get along the way.
So presumably there are a lot of smart, well-heeled organizations out there who are turning up their noses at what you guys are trying to do. I want you to give me a sense of what the status quo is and why it's broken, and frankly, why everyone should be as gung-ho about doing it a different way like you guys are.
So I think previously I said I don't think everybody should be a gung-ho. I think Secha Capital plays in a middle space here where you've got your private equity for your established businesses, and then you've got your venture capital for your earlier stage businesses. Why we see this being different is, and
So wait, do you feel they have a place and you guys are taking like white space in the middle?
Depending on the size, yes. So at the very big private equity sizes, yes, that model makes sense there where you raise $500 million and then you take the 2% management fee, and then that makes sense. And then the venture capital size where you write a check and then you have a board seat, maybe you provide some advisory services for an early stage startup, yes, that makes sense. But what happens when a company is already established? What happens when they want to take that growth step? How do they get there? And if you look at, I think, going back to the impact story of what Secha is trying to achieve, SMEs in South Africa in particular, there's 2 million of them. They employ 2/3 of the workforce. They contribute 45% to GDP. So this is an important sector, but who's focusing on it? It's not the venture capital companies. It's not the private equity companies. And then how do you, if you are going to invest in them, how do you make it work? So you can't raise $500 million or rands or whatever it is, because then you have to write big check sizes, and then there aren't that many companies. And then in addition, if you look at the top 3 pain points for SMEs, broadly speaking, in South Africa, it's management talent, channel access, and lack of funding. So the way we structured Secha was essentially to solve those 3 problems, where we take those operational roles to assist the teams with the management talent. We've got shareholders who are entrepreneurs or used to be entrepreneurs. We've got a great network from our days at Bain, and we can open up these channels to these entrepreneurs, and then obviously coming in with some of this growth capital. But that growth capital is at a smaller check size, and it's a lot more impactful when you can write a 2 million rand or 3 million rand check, that you can immediately see the uptick in this working capital cycle for these small businesses.
So Brenden, give me a sense of some of the people you would have tried to enthuse by sharing this thesis and looked to partner with perhaps in some way to take it off the ground, and give me a sense of some of the responses you got that turned you down, and then reflect on that. Give me a sense of the ones that made you mad offhand, or the ones that, you know, you sort of understand where they're coming from. Or there's a wink going on in the room. You guys can't see it, obviously, but they're winking at each other. Yes, guys, we're here to talk about this. I have to imagine there were a lot of no's, despite the whole Bain thing and being Oxford, you know, Cambridge.
Cambridge.
Okay, so I nearly got that wrong, and then I thought Brenden was like a Harvard dude, but no, he's Duke. But yeah, despite all that sort of flying around the room, your just consulting background, and what clearly is at this point a decent idea. Talk me through some of the people who didn't believe and why.
Yeah, sure. I'll answer that question in 2 parts. Number one, the people that didn't want to necessarily fund us, and why, and secondly, the people that actually have turned down money we want to give to them, which is also fair. On the first part, the 2 and 20 model is the way private equity has been done for the last 50 years, and private equity has quintupled in the last 15 years alone. So
okay, so we most of our listeners aren't financial heads. So 2 and 20.
Sure, 2% management fee, as Rushil said earlier. If you want to cover office salaries and such, you want to raise a lot more money to be pulling that 2% management fee, and then the 20% is the carry. The way Secha is different is we just pay ourselves a nominal salary that we earn in sweat equity from our opcos, but we did not have to raise a ton more money in order to justify kind of, and then as you can see, this office space, thankfully our cornerstone investor, Kaleo Capital, gives it to us at a subsidized rate, and we get interns. So we're very asset light. We have very low overhead. We optimize for operations. All right. So that's how Secha very succinctly is different. And that difference, this model, structured more as a holding company than as an LP, limited partner, GP, general partner relationship, that innovation concerns, scared some people off. And some people that were very interested in it, but DFIs that we would speak to, just a number of high net worths, organizations that, sorry, we like this patient capital model, but we're just not comfortable with it. And that's part of what we're here to prove with Secha. We would love more copycats. We're not necessarily very scalable as a team, but we're very replicable. So if more people brought on this model, that would be a success for us for this proof of concept, because ultimately what we're trying to do is change the stocks and flows of growth and human capital into SMEs. Less focus and attention and money, or maybe not less, but not 100% focus and attention and money on tech plays and startups like that, but more on the heartbeat of the economy, these SMEs. So that is some of the no's that we got, right? Because this model is innovative from a structural standpoint.
Were they polite no's, or did they make you sort of start to doubt the sensibility of what you were trying to do?
Andile, you know me well enough. I would love to say something provocative, but we had an amazing experience. We really did. Everybody was very respectful. I think they saw at least that it was an interesting model, but oftentimes it was it was too much for them to pull the trigger on kind of getting in bed with us. And basically they said check back later, as well. So, once you guys do prove it out, and if you want to raise additional funds, come back to us, and that's the name of the game from a capital raise standpoint, right? The no's today become yeses in 3 to 5 years, and we're in it for the long haul. So we're happy to do that. I'd also like to say that we have approached companies to invest in them, and sometimes that's almost been harder because it's productizing, our skill set from Bain, the MBAs. And when you talk to a founder of an SME that they're doing 25 million rand a year and they have a great product, they don't necessarily see the value. So it's incumbent on us to prove ourselves. Sometimes that's the channel access. Sometimes that's an insight into their price pack architecture that they didn't realize. And that's a good thing. That's good to get that no. We often say that the companies we invest in, we almost don't want them pitching us. We want to go out and pitch them. So that's part of the fun too. So I guess to summarize, we got a lot of no's. So it took a lot of persistence to get even where we are today, which is still very much the beginning of the journey.
And so Rushil, this addressed the whole tech enablement thing, right? Because, speak to the trendiness of sort of investing in tech startups or tech-enabled startups or businesses, and why that's not how you guys have decided to approach what's worth investing in.
Sure. So I think our skill set, myself and Brenden, our skill set doesn't lie in tech. It lies in FMCG and agri-business sectors. So this is what we used to do at Bain. We used to work for these large businesses, and we realized the tools and frameworks were just as applicable to SMEs. I do see the tech world being useful, but I think if you look at job creation again, which sectors are the highest job creators, it's in the trade, agriculture sectors. So this is where we can make our impact, and Secha's impact mission is job creation. But that being said, I think we mentioned this last time as well, that every company that we invest in needs to have some sort of technology component, not necessarily to the business, but where technology can help it accelerate its growth. So whether that's a cloud-based accounting software, or whether that's a mobile-friendly website or e-commerce platform, those are the tech tools that we like to use, that we think every business needs to take advantage of. And it wouldn't be possible if there weren't people funding those e-commerce platforms or the payment gateways, etc. It's just not where our expertise lies.
So in the context of, what Rushil just said, how do you engender like a healthy appreciation for preparing for, quote unquote, the fourth industrial, revolution, as it were?
Yeah, to echo Rushil's point, these companies are certainly not Luddites. I'm looking at the products of the 3 operating companies that we have now, and they're all tech-enabled in some way and would not exist if not for recent tech. Native Child, so it's natural hair care for ethnic women, that was built on Instagram, right? Until recently, it was 80% sales were e-commerce. Now we're in more and more retail, and that's been smoothed out. But that could not have existed without Instagram, without support from Facebook and social media ads. Biltong, Staffelberg Biltong. So Staffelberg Biltong is now in Engine stores nationally. And how are we keeping track of all our sales reps? Well, using an app on a smartphone. So we know where they are, when they checked in, taking a picture of their merchandising. That's an incredible tool. Very cheap. Would have been so much more expensive just a few years ago. And yet it's still creating great jobs, right? These jobs haven't been taken away by tech. And these are still your classic 9-to-5 jobs that pay well, that maybe you don't find in tech. Now I'm looking at G-Step shoes, or BKLYN. That's the trendy private label shoe. Well, BKLYN, when we added a few more pay gates to the website, a few more payment applications, so not just sending an EFT or just using a credit card, sales tripled in month over month because of the fintech revolution that's going on. So a lot of these companies can succeed on the back of them. So it's incumbent upon us as investors and as operators with the entrepreneurs that we need to ride the waves with them. But again, as Rushil said, it's not our play just to invest in pure tech. We don't take tech risk. We think that there's still so many great SMEs out there that can use a little bit of help. Secha is my wife's native tongue, Songa. It means search, right? So our idea is that we don't need to help build the next startup. We're not there. The next great African company is already out there. It just needs a little bit of help, and that's the role that we're here to serve.
And now, Rushil, we've had some conversations offline about, well, I've shared with you my concern that a bubble's forming around the current sort of tech-focused VC approaches on the continent. I suppose I want you to give me a sense of whether it's sound to say the popular doctrines of VC that are mostly borrowed from Silicon Valley being applied to tech startups and startups in general. I think there's a lot of pressure on non-tech startups as well to display this sort of crazy traction, crazy growth, or hyper scalability, or whatever it is, you need to sort of show to just prove, one, that you're a startup, and two, investable. What do you think is the most important thing for people to start to understand so that, we don't create a precedent for a landscape where people are monetizing off value that hasn't even been created, and, just 2008 in a much smaller version all over again, within the context of VC on the continent. So it's a long question, but do you get a sense of what I'm asking?
So I'm going to do my standard disclaimer where I'm not a tech expert, and a lot of what I'm going to say I've learned either from your podcast or just reading.
Stop it! Get out!
I think it's so cliche, but people just really have to stop treating Africa like Silicon Valley. The dynamics are just so different. In the US, you've got 300 million people, so it's a huge market. You've got a lot more capital chasing a lot fewer deals, and therefore that's why the valuations keep going up. And that's why you get investors investing in things like Juicero, or with crazy valuations for products that don't actually add any value. But where I see the in the African context is if you're going to have a tech startup in Kenya or Nigeria or South Africa, you're often going to start with a much smaller market, with obviously ambitions to go into the rest of Africa or the rest of the world globally. And I think investors need to realize that, where I think there's this risk-averse nature for a lot of investors on the continent, because you may not have the management talent or the pool of talent that you would say have in Silicon Valley. So you can just throw money at the problem. Where I forget the guy's name in Egypt who sits with his opcos every week.
Khalid Ismail.
Yeah, so he's got a great approach to supporting his entrepreneurs, and if I'm not mistaken, I think he has some tech plays in his portfolio, and I think that's what needs to happen. Investors, and I think Brendan's literally got his sleeves rolled up right here. We really have to get our sleeves rolled up and get dirty, and I think that's what it's going to take. It's going to take this community approach to building the ecosystem, if you will.
Do you think I'm Chicken Little or Little Chicken Little, and worrying that the sky is going to fall, Brenden, around this issue? Because I really do think it's a problem. And the reason I dig, Secha and the hybrid thinking that you guys espouse is because I feel like it's old school. There's something about it that just makes sense, in the sense that, find great businesses that are, growing modestly yet profitably over, sustained periods of time, and you will make your money, and that's cool. And sometimes you'll find opportunities to grow exponentially, and that's great too. And, my problem is not with, an investor who's committed to finding something that's really rooted in tech, or even something that has this amazing ability to leverage tech to grow fast, or make exorbitant profits. Or I have no problem with that in essence. My issue is with a culture, an investment culture that allows people to exit profitably without value being created. To me, that's just morally problematic and just bad business. And there's going to be a bubble; it'll burst, and we're gonna be holding the baby as a continent, as a culture on the continent, entrepreneurial culture. Am I making too much of this?
The way we see it is that tech investment absolutely has a role. It's not ours. The concern that I guess I could share that I see that you just described would be that we're focusing on companies that won't create value, where there's so many that can and do, and then could do more if there's more capital. In a way, as I said earlier, we would love to have people more people like us in this space to do this kind of human capital arbitrage. But right now, our deal flow is, we don't compete on deals. We're seeking people out. There should be more money in this established SME space. Now, that said, I think there is a lot of good tech work going on. I mean, we really like what the Silver Tree guys are doing over in Cape Town. They're creating that platform. They're doing a lot of smart things. But on I believe a competing podcast, I heard the founder of Sweep South. And those unit economics sound amazing. So there are great things being done. So I'm less concerned about a bubble from a financial perspective, and more of just a missed opportunity cost to grow SMEs and grow the human capital talent that goes along with that. Because there's still so much opportunity. And again, one of the founding ethos of Secha was, as an American, I'm tired of seeing Burger King down the street or drinking, no offense to our friends at Nestle coffee, from the grocery store. These need to be local African brands. And then when you grow those local African brands, those profits stay here. And that creates that ecosystem of the next round of investment. So that's what we're aiming to do. If it can be done via tech, great. But it should also be looked at in the FMCG and agri-business space as well.
So, Rushil, you are in many respects effectively... I want to be respectful to your portfolio companies, but I mean, you get deployed in your investees as essentially their boss, in a sense, right? And I use that as a segue to asking you to think about perhaps some of the leaders you've had to work for, under, with in the past that, frankly, you'd have some things to say to, in terms of like things that they could have been better at, right? So I'll give you a minute to think about you in your role as a leader within the context of your investment firm, as a leader within, or as part of a leadership team, perhaps within the investee setup, sitting on a board, as a COO resource, a CEO resource, or whatever is relevant. And then think about the last time you had to defer to someone. What would you like that person you just thought of, what would you like them to know?
So I think I'll answer that by first negating what you first said. I absolutely don't go in as a leadership position in any of the operating companies.
What does that mean? Let's maybe unpack what leadership means, and maybe what it is about the way I introed it that doesn't sit.
I think what you said later makes a lot more sense as a CEO resource or a COO resource, right? So I am a resource that they can leverage to get something done. And obviously we Brenden and myself will come with a different skill set, we'll come with a different network, advisors, mentors, whatever that is. And we encourage our operating company leadership teams to use us as they see fit. Obviously, we'll provide some input on how we think we could plug in best. But again, it's just a CEO resource.
So why is it important that be super clear to you and perhaps your investees or into people listening? Why was it really key that we don't get that twisted?
So I think it's because of the fundamental nature of the Secha model is we take minority stakes. We don't ever want to have majority stakes. We don't ever want to run the businesses or be the CEOs. We think our role is to empower these entrepreneurs to grow their businesses. And when they have a majority stake in their businesses, they're that much more incentivized to grow it. So I think it's a fundamental part of Secha's model is to not take controlling ownership stakes and not to be seen as a authoritative investor coming in and dictating what needs to happen.
Have you just described the ethos of your personal leadership style and what you guys are trying to go for?
Possibly, yeah. I think it's very much a collaborative approach, and I think the reason why we've decided on this is it's really difficult to go to operating company, someone who's been around for 3 years and want to take part of their baby. They really see this as their baby. So we're here to tweak the model to see how we can fit within what works for entrepreneurs, what works for investors, shareholders, all of those players in the fund support value chain. So I definitely think it is this collaborative way of working. Maybe that is a succinct way of answering that.
So while you're thinking, Brenden, a more direct question, you must have had bosses who sucked, leaders who sucked. You might have had to work for them. There might have been clients. You might be related to them. There might be people you know in your current circle.
Seems like it's getting personal.
Yeah. Sorry?
Seems like it's getting personal from the interviewer side now.
No, not at all.
A brother that owes me money.
Not at all. Actually, I'm pretty lucky with that. With my I've been fairly lucky, but I certainly have a laundry list of leaders I've had to work with or for that I could think of right now, and I want you to do that as well. So I want you to think about the one that probably gave you the hardest time, or the one that you perhaps promised yourself you'd never be like, and I want you to tell them what you wish they ought to know about either your experience, what you've learned, perhaps something you could teach them, being that you're a leader of a different sort now.
I think it has to do with the ego of leaders. And if I think back to two examples of what you were describing, and maybe Brendan won't like me for this answer, but
it's not about Brendan, is it?
well, I mean, he's my partner. I think what they need to realize is, you can leave your ego at the door. You don't need to always make the decision. You probably aren't always right. And when I look at the bosses that I've had in the past that have given me grief, I would like to tell them that, hey, this is a job. This is a faceless entity. Yes, it has a culture, but on the other side of it is a human being with a family and a life. And you've got to understand what's important for people, right? If your work's the most important thing in your life, great. But if your family is, then you need to recognize that. And I think that's how you should engage, by understanding people's lifestyle choices or what's important to them, and then working around that.
Brendan, you've had far more time than Rushil to think about a response to this question. What would you say?
Two things that it kind of piques in my interest in my mind, and Rushil really covered one of them. So I'll start with the first one is kind of putting on the the shoes of the other person, of your subordinate, and that's why the apprenticeship model is a big component of Secha. The skills transfer playbook, working alongside the entrepreneurs. This is a big reason why we do that, is because that's the best way to learn, but that's also the best way to get things done and understand how they get done, which leads to the ego component. It's funny, I was just on Saturday speaking at the Harvard Business School Business in Africa Conference. So these are HBS, MBAs. They asked for advice at the end of the panel. I said, you guys are the best and the brightest, and I'm sure you've already been at Bain, McKinsey, or Goldman, or what have you, and you're going to learn a ton if you haven't already. So absolutely hold on to those skill sets, but also know when to disregard them. So Rushil and I don't use everything we learn at Bain. I'd say we cut out half, because that doesn't work on a day-to-day basis with the SMEs. Now, that other half that's still there is huge. And that leads to, we don't always have the answers. I have learned so much from the executive team at Stoffelberg, from the founder of Native Child. And no, they don't have MBAs, but they're super sharp. And just because their CV doesn't read as fancy as these Harvard Business School kids doesn't mean that you can't learn from them. And that I wonder if that comes across as a little cliche, but it is so true, because getting business done, the way business is done, it requires a lot of components that aren't taught at university, and that you don't learn, from a fancy corporate office. So that's a lesson that we try to remind ourselves all the time when we have a frustrating day, or when I was quite literally laughed out of a retailer. We had a meeting with a Pan-African retailer 2 weeks ago. I had a launch plan PowerPoint deck, and they just laughed at me, and they said, "Come on, we do this over a handshake." And that's a lesson, right? It's a surprising one. I'm not entirely comfortable with it, but these are lessons that you learn, that sometimes business is done differently and done rightly, because it's quicker or more more efficient. And those are the things that I think bosses I've had in the past wouldn't understand. They'd stick to their 100%. No, we're going to go through this PowerPoint deck, or they would not realize that they could also learn by not using it.
So, guys, final question for you both. Give me a sense for something that might be trending in your lives, professional lives here at Secha, that might surprise the average person who may or may not be, au fait with investments, with VC hybrids, PE hybrids. Yeah, I mean, I'm in your office right now, and I get a sense of, there'd probably be, if I was a fly on the wall here long enough, there'd be things like, oh, that happens here? Oh, okay. Give me a sense of, like, you just mentioned one now. I mean, you transported me into one of your pitches, which I suppose in the minds of a lot of people might be, hey, more of those go well, or at least better than what you just described. So that was revealing. That was quite interesting to hear. But in terms of what's trending, give me a sense.
I think for me, it's understanding or trying to gauge an entrepreneurial DNA. I think that we have 3 operating companies now, and we've met with a ton more. And I'm internally trying to codify what makes a great entrepreneur. I can feel it, I just can't articulate it. So working with G-Step, where the founders decided that they want a factory now, and just trying to see why did they make that decision? What has driven them to have that gut feel that this is the right answer? And obviously I went and did the math, and yes, it does make sense. But what makes a great entrepreneur? And this is part of the playbook that we're trying to codify, because when someone does replicate the Secha model in a different industry, how do you identify greatness in an entrepreneur that you can work with? So I think that's my focus at the moment, is trying to build something on PowerPoint that I intuitively feel.
So that one day a bot does your job.
Pretty much, yeah.
Good luck. So I have some advice for you on that front. I just reached into my laptop bag here, a book called The Villager by Faye Olubodun. The Villager, How Africans Consume Brands. This will help. It won't get you all the way there. Your bot will not be made, I can assure you, but it'll help at least a little. And I mean, being that, you're born and bred here in South Africa, you at least have a head start on a lot of other people, not least Brenden, who perhaps wasn't so lucky, right?
Yeah, exactly. I think it's something about this culture, or being part of the culture that you'll have to intuit, I guess.
Well, he married into it, so I suppose he's trying his best to even the playing field. But nonetheless, what would you say is trending for you, Brenden?
Well, sure, and maybe I can even use it as a call out for the next company we'd like to invest in. We very much would like to invest in what we would call a traditional trade company. So maybe that they're not necessarily in modern retail, much lower price point, and we have yet to. And I say that as to what's trending. We have seen a lot of these kind of niche growth products within larger markets. I mean, so Native Child is an example of that, right? It's hair care for ethnic women. Normally, it's a big multinational that just makes a very, wide tent product. And I think Santo found that, grew it on Instagram. And now Native Child's a fantastic product today. It's growing like crazy. We'd like to find a product, in a similar kind of niche that consumers can kind of build today, that we can clearly see, but we'd like to find it at a lower price point that maybe it's bigger in the townships, and that's something that we are working on day in and day out, because I am American, and I live in Parkhurst, and I want to make sure that I am plugged in to the mass consumer, because that is what is going to grow as South Africa continues to progress, and those are going to be the decision makers going forward. So we want to make sure that we understand them, and that we're speaking to them. If there's any great companies that kind of fit the description of the model we described throughout this, and then just now that if you're big in Alex, you're big in Soweto, we want to talk to you. We want to give you growth capital and help you grow some more.
All right. Well, guys, thank you. It's been a great chat. Thank you, Brenden. Thank you, Rushil. Secha Capital, check them out.
Very happy to keep chatting to you.
Yeah, thank you. Great to see you, and